Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. The Bank of Canada hiked interest rates by a full percentage point, the largest increase since 1998, in a bid to squash stubbornly high inflation. It was a surprise to many, and together with red-hot inflation figures coming out of the U.S., triggering even more nervousness in the markets. Join me now with her thoughts on the economy and how to position your portfolio in these uncertain times is Lesley Marks. She's Chief Investment Officer of Equities at Mackenzie Investments. Hi, Lesley. Great to have you on.
Hi, Saijal. Nice to see you again.
So, Lesley, a hefty 100 basis point rate hike, a surprise to many. Were you surprised? And do you think that this hike will make the impact that they wanted to make, and that is cool demand? Because it's certainly not having the impact in the U.S. if you look at the latest inflation figures.
Well, yes, to answer the first question, we were absolutely surprised by the 100 basis point hike. We were looking for 75 basis points. To answer the second question on impact, I think it's premature to see impact in some of the areas that central bankers are particularly focused on. Obviously, most notable CPI. We saw a very high print yesterday in the US, ironically on the same day that the Bank of Canada came out aggressively. That's probably shifted the Fed towards 100 basis points in thinking in their next meeting as well. But some of the leading indicators are really starting to show impact. And there's a lot of signals as well in the market. We've seen it in the commodity complex. A lot of commodity prices have come off pretty substantially from their peaks or their current year peaks. So we're starting to see the impact from an expectations perspective. We've seen inversion in the yield curves also starting to show that these interest rate increases are likely to lead to a slowdown or potentially recession towards the this year.
Yeah, and I was going to ask you, is that what they have to do? I mean, they're not going to publicly say it, but do they have to engineer a recession to cool this demand off?
Well, it's certainly not the intention. If you go to the press conference from yesterday from the Bank of Canada, they talked about explicitly targeting a soft landing. So is it possible that the unintended consequence is a recession? Yes, and probably likely. But right now, the goal, the stated goal would be a soft landing. Now, you know that the central bankers have to focus on can only focus on the demand side and not the supply side. So I think what we heard yesterday with the surprise move is that they are going quickly and aggressively at targeting demand. And that was certainly in the messaging.
Lesley, the markets are, it seems they are certainly pricing in a recession. How much downside do you see in Canada and the U.S.? I mean, Canada obviously has the commodity play in its favor for now, but you just said that you're starting to see some cracks there.
So I think it's hard to say exactly how much is priced in. What we have seen so far is merely multiple contraction. The S&P TSX is trading at 11 times this year's earnings, and we think those earnings are pretty good. There might be a little bit of downside throughout sort of the second half of this year, but because most of the earnings momentum is coming from energy revisions upwards, and energy is still significantly higher on an average price basis this year versus last year, we think the earnings outlook is pretty safe for Canada. So the next shoe to drop, though, is the perception that earnings need to come down. And I think we're going to see that more in U.S. earnings. Canada, I think that will be more of a 2023 story.
Okay. Lesley, we only have about a minute before the commercial break. What sectors are you looking at specifically that show some, decent valuation? And maybe the other question is, how are you gauging it? Like, what are things that you specifically look at?
Well, I think the important thing here is to have a perspective, a long-term perspective. And what we're seeing right now is an acceleration in a negative outlook for both the consumer and for businesses because of how aggressive central bankers are being are tightening financial conditions. So when you look across sectors, probably the safest place to be are sectors that are the least economically sensitive, because that's what's really coming into the focus and coming into the shorter term horizon. And that was certainly not our outlook at the start of this year, but it is becoming increasingly apparent that global economic growth is going to slow in a significant way.
Okay. Yeah. Okay. We're going to take a quick break and we'll continue this conversation. We'll be right back. Welcome back. Lesley, before the break, you were talking about looking at the least economically sensitive stocks, probably the defensives. So continue. What are you seeing there, and where are you seeing the opportunities?
Yeah, so I mean, I think the sort of the safest place to be right now when you're going through a recalibration of economic growth is in defensive sectors like healthcare, like telecom, like consumer staples. Now, many of these sectors are priced reflecting that, and they're at premium prices. So you have to be, as usual, picky around the stocks that you look at within the sector. So I'm generalizing on the defensive sectors. I think where you don't want to be, as I said, are on things that are very much levered to an economic recovery, at least not right now. There will be a time for that. And we are going through a traditional, old-fashioned business cycle here, engineered by the central bankers removing excess liquidity, which is causing demand to be over capacity right now in the market. So there will be a brighter day in our future, but right now we have to work through this excessive demand period.
And Lesley, I guess for defensives, I mean, the reason we talk about that is these are products that you need no matter what, right? And whether the economy is down or not. Are you seeing signs that most of them are able to pass on higher costs, or is it still sort of a stock picker's game?
Mm-hmm. Mm-hmm. Well, I think that's a very good point to focus on, Saijal, because when you think about it, we have seen many companies have pricing power. But as the consumer starts to lose faith or confidence, which we're definitely seeing in the leading indicators, the ability for businesses and producers to pass on higher prices is going to be much more difficult. Mm-hmm. And so, those companies are going to be few and far between. And so the next place that one needs to focus on as an investor is where companies end up, having that unique pricing power, regardless of consumer sentiment, and as you mentioned, in places where they're necessary goods like consumer staples, but also where companies have very strong free cash flow that they can use to support their stock, either buying their stock back or paying dividends. So there's many companies around the world globally that are in that fortunate position here where they will really stand out and be highly desirable for investors in a more challenging environment.
Okay. Lesley, speaking of global, I want to talk about China for a minute because it is the second largest economy. So things that happen there do actually have an impact here as well. What are you seeing there in terms of both headwinds and maybe opportunities that we should be aware of?
Well, China is a major focus, certainly for us in our latest mid-year outlook report. It was one of our three key themes, including central banks, inflation, and of course, China. And the reason, as you mentioned, is because of the role that it plays in the outlook for a global economic growth. When we started the year, we thought that China could be a bit of a contrarian play because we expected to see Chinese policy be a lot more accommodative, both on the monetary and fiscal side, and that was going to be very unique in the global landscape. What has transpired since then and made things a little more challenging for China has been this focus or commitment on the dynamic zero COVID policy. And that has resulted in policy leading to lockdowns in significant areas of the population in centers like Shanghai and Beijing, which has had a strong impact on the outlook for economic growth in China. And frankly, as you said, intertwined with the rest of the world. So China has been a bit of an anomaly and behaved differently than the rest of the world in the sense of policy. And so I still think there's a chance it could be a contrarian play for this year, but my conviction level is admittedly low.
Okay. Lesley, we only have about 40 seconds to the end of this interview. What signs are you watching for now that might indicate that the worst is behind us?
Mm-hmm. Well, there's three things that I focus on. One is GDP growth and the implications that has for earnings. We've talked about the fact that there's probably a downside coming in earnings expectations globally. The second is, are the central bankers close to being done? I think we have a clear indication that that's not the case. So a little more to run there, but there is a very aggressive tightening priced into the market. So in that sense, what the market is expecting, we're close to being done. And the third is sentiment. And I don't think we're at the point of a bottoming in negative sentiment. Sentiment is not negative enough yet. And we would be seeing that in fund flows coming out of equities. And we're just not seeing that yet.
Okay.
So that's what
Thanks so much for coming on today. Appreciate it.
Thank you, Saijal.